Welcome to Asia Briefing's Legal Podcast. My name is Israel America Jones with Dezan Sheeran Associates, Marketing Manager for the North China region. Today with me in Beijing is Ms. Rachel Xuan, Manager of our Business Advisory Services. Dezan Sheeran Associates is a specialist foreign direct investment practice providing business advisory, accounting, tax, and payroll services to companies investing in Asia. In this legal update, Ms. Rachel Xuan will discuss exit mechanisms for joint ventures. Rachel, what are some of the current drivers of joint venture activities for foreign small to medium-sized enterprises?
Okay, the main current drivers of joint venture activity for foreign SMEs, basically meaning small and medium enterprises, can be seen from two perspectives, the legal side and the commercial side. From legal side, for the foreign investors who want to directly invest in China, the Chinese government has mandated that foreign investors must partner with Chinese companies to invest in key industries. The Chinese government has prohibited foreign investors from setting up offices in oil exploration, university education, and land development, etc. A common misunderstanding is the requirement of needing a Chinese partner for foreign investors versus that industry being on the restricted industries for foreign investors as listed in the catalog of industry for guiding foreign investment. In actuality, at least half of industries which the government required a foreign investor to set up inside of a joint venture structure falls into the encouraged industry category for foreign investment. In contrast, foreign direct investment in restricted industries is difficult to impossible. However, the approval of foreign direct investment is not difficult in encouraged or permitted industries, despite the Chinese partner regulation. Secondly, from the commercial side, foreign investors are attracted to the joint venture arrangement because of the already established resources owned by the Chinese partner, such as existing distribution channels, very good Chinese market shares, and good government connections, which frequently help foreign investors establish in China. Unlike the legal perspective, the commercial incentives to establish a joint venture are more natural for the foreign investor. The above basically are the two current drivers of joint venture activity for foreign small and medium enterprises.
Seeing the current drivers for foreign SMEs, what are some of the conditions for disillusionment of a joint venture? And what do you suggest a party to do in order to dissolve a joint venture?
There are two types of dissolution, voluntary dissolution and involuntary dissolution. First, we will discuss voluntary dissolution. It means that the company is dissolved at shareholders' discretion, and the whole liquidation and dissolution process is managed by shareholders. Secondly, involuntary dissolution. It means that shareholders have lost the control of the company, and the company is involuntarily being forced to dissolve. Involuntary dissolution occurs when the business license of the company is revoked by the government authorities or the company is insolvent. Usually, reasons for dissolution could be first, financial losses, second, a breach of contract, third, force majeure, fourth, failure to reach business objectives. Of course, there are more other reasons. It is important to remember that the above-mentioned areas are to be clearly defined in the contracts with respect to scope or limit. This will allow a smooth initiation of dissolution by either party.
Moving to the next question, what is a deadlock provision and why are these important?
Actually, this is an important addition to a contract relating to dissolution either. A deadlock provision is not required by law but creates a safer contract for both signing parties. A deadlock provision is a special clause defining when the board has entered into a deadlock and what circumstances comprise a deadlock situation, defining in detail what a deadlock is and when a deadlock has been reached is essential for the execution of the deadlock provision.
Do you recommend incorporating a buy-sell option when creating a JV? Why or why not?
Yes, I do recommend incorporating a buy-sell option. A buy-sell option or buyout option can be an extension of the board deadlock clause, or it may also be an independent clause, especially when the foreign investor is forced to enter into the joint venture arrangement because of the Chinese foreign direct investment policy. The buyout option usually provides that in a certain circumstance, one party should have the right to buy out the other party, while following the detailed pricing and payment terms.
Thank you, Rachel, for this presentation on exit mechanisms for joint ventures. If you have any questions for Rachel, please contact her at rachel.xuan@desanshira.com. For more information about business regulatory news, please visit our website, www.asiabriefing.com, or email us at podcast@asiabriefing.com for more interesting topics that we can discuss in our next podcast. Thank you for listening and look forward to having you join us again at Desan Shira & Associates Legal Accounting Update.